This is the kind of day that makes people hate markets. Silver didn't drift lower over a month. It didn't bleed out over a week. It fell so fast that your brain couldn't even process the numbers on the screen. One moment you're looking at a price that feels high but normal, and a few hours later it's down 40% like someone cut the power to the entire market. If you were watching that in real time, you know the feeling. Your stomach drops, your hands go cold, and the only thought you can hear in your head is this the one? Is this the crash where silver never comes back? If you're panicking right now, I need you to do one thing before you do anything else. Slow down, because the story the chart is telling you is not the real story. A move this violent is almost never people deciding silver is worthless. It's usually the paper system snapping under stress. And if you don't understand the difference between a real demand collapse and a paper unwind, you will make the exact mistake this market is designed to force you into, selling the bottom out of fear while smarter money buys your panic. By the end of this video, you're going to understand what it actually means when silver drops 40% in hours, why this kind of move happens in the paper market even when physical demand is still there, how far it can still fall from here in realistic terms, and the signals that tell you whether this was the final capitulation or just the first crack in a bigger unwind. I'm not here to hype you. I'm not here to calm you with hopium. I'm here to give you the structure so you can think clearly when everyone else is emotional. Let's start with the simplest timeline, because chaos feels less chaotic when you put it in order. Silver was trading at a level that had people excited, confident, even greedy. Then volatility started rising. That's always the first warning sign. After that, the market hit a trigger point, usually something like a margin change, a liquidity vacuum, a sudden spike in the dollar, a sudden dump of paper contracts, or some combination of all of them. The first leg down hits, stops get triggered, leverage traders get margin calls, forced selling begins, and the market transitions from selling to unwinding. That's an important word. Unwinding is not the same as people choosing to sell. Unwinding is when the system forces selling regardless of what you believe about silver. And this is why these crashes look unnatural, because they are unnatural. Not in a conspiracy sense, in a structural sense. A normal market moves when buyers and sellers negotiate. A forced unwind moves when rules and leverage create automatic selling that doesn't care about fundamentals. Now let's get heavy and real about the mechanism, because this is where most people lose the plot. There are three forces behind a crash like this, and each one has an analogy that makes it click. The first force is leverage, and leverage turns a normal market into a domino stack. When silver is being traded through futures, options, and leverage products, the market isn't the metal anymore. The market becomes debt. People aren't holding silver, they're holding exposure to silver with borrowed money. That works beautifully on the way up. It makes gains feel easy. But the moment price starts falling, leverage turns into a domino chain. One margin call knocks into the next. One liquidation triggers another. It becomes mechanical, it becomes mathematical. And once a cascade begins, the market is no longer about whether silver is scarce or valuable. It's about whether traders can meet margin requirements right now. Think of it like a skyscraper with too many floors built on debt. When the foundation shakes, you don't lose one floor. You get a chain reaction. Floors collapse into floors. That's what leverage does to price. The second force is margin and rules, because in paper markets, the rules can change while the game is still being played. That's why I call it the floor disappearing. In many leveraged markets, you're not losing because your thesis is wrong. You're losing because the minimum cash required to stay in the trade rises, or because price moves faster than stops can execute, or because liquidity disappears at the exact moment you need it. In a 40% intraday crash, stop losses don't feel like protection. They feel like a myth. You don't get stopped out where you planned. You get filled where the market can fill you, and in a vacuum that can be brutal. The most dangerous part is that margin dynamics don't just punish reckless gamblers. They can punish disciplined traders too, simply because volatility becomes too large for the system. When margin requirements are high, the smallest shock force is liquidation, and liquidation pressure creates more shock. It's a feedback loop. The third force is liquidity, the fire exit being locked during a crowd panic. In normal conditions, there are bids, there are buyers, there's depth, but in a sudden unwind, the book thins. The buyers step back because they don't want to catch a falling knife. Market makers widen spreads or pull liquidity, and then price doesn't fall step by step. It falls in gaps. This is why you see candles that look like cliffs. It's not a gradual decision. It's an air pocket. Put these three together: leverage dominoes, margin floor disappearing, liquidity exits locked. That is the recipe for a 40% crash in hours. Now here's where the story gets even more important, because a move like this creates a massive question in every investor's mind. If silver can fall 40% in hours, does that mean silver is broken? Does that mean silver can go to zero? Does that mean the bull story is dead? Let's be blunt. Physical silver cannot go to zero. The industrial world would not allow it. Silver is not a meme coin. It's used in electronics, solar, medical applications, advanced manufacturing, and countless supply chains. Even if speculative money disappears for a while, industrial demand doesn't vanish overnight. But, and this is a big but, paper price can overshoot dramatically in the short term because paper selling can exceed physical reality. That brings us to the part that confuses people the most: the disconnect. In this type of event, you can have a falling paper price while physical silver becomes harder to source at reasonable terms. You may see delays, limited stock, higher premiums, rationing behaviors, or tighter dealer spreads. I'm not saying every mint everywhere is definitely out of stock at this exact moment. Availability changes, but the key idea is real. In stress events, paper can crash while physical tightens, because the paper market is unwinding leverage while physical demand sees discounts and steps in. This is why you can see a chart screaming collapse while real-world buyers see opportunity. Two markets, two motivations, one price. Now, I want to show you the receipts you should be looking at in a situation like this, because if you only watch price, you're blind. The first metric is open interest. If silver is dropping hard and open interest is collapsing with it, that's usually the fingerprint of liquidation. It means positions are being closed, not just transferred. It suggests forced exits rather than a clean voluntary rotation. That matters because liquidations end. They don't go on forever at the same intensity. They exhaust. The second metric is volume relative to range. Huge volume on huge candles often signals panic and forced flows. But here's the nuance. High volume alone doesn't mean bottom. Sometimes it means first break. You want to see whether the market begins to stabilize after the high volume event. If volatility stays insane and selling continues in waves, you may not be done. The third metric is the spread between paper price and physical premiums. Again, premiums vary by region and product, and they change quickly. But if paper collapses and premiums don't collapse with it, or they rise, that tells you physical demand is not agreeing with the paper price. That's a stress signal. The fourth metric is lease rates and short-term financing conditions. When physical metal becomes difficult to borrow, borrowing costs rise. That can indicate tightness. Not always, but in combination with other signals, it matters. The fifth metric is the behavior of the dollar index and real yields. Silver is extremely sensitive to macro liquidity. If the dollar is ripping higher and real yields are rising hard, metals can get crushed regardless of long-term fundamentals. If the dollar rollover begins and real yields stop rising, pressure can ease quickly. Now, you asked the most important question: crash के बाद अब और कितना गिर सकता है? Let's answer that in a responsible way without pretending anyone has a crystal ball. When a market falls 40% in hours, two things become true at the same time. First, it is extremely oversold on short time frames, which increases the probability of a sharp bounce. Second, it has proven that liquidity can vanish, which increases the probability of another violent leg if a second wave of liquidation hits. That's why these periods are emotionally brutal. Both outcomes are possible: a bounce that tricks you or a continuation that breaks you. So instead of giving you one fake exact target, I'll give you three scenario zones with logic and invalidation points. Scenario 1 is the capitulation low. In this scenario, the 40% crash itself was the clearing event. Most leverage was wiped, weak hands are out, the market stabilizes, bounces sharply, and spends days or weeks repairing. In this scenario, downside from here is limited. Maybe another 5 to 10% extreme wick, but not another full collapse. What invalidates this scenario? If you see another surge in forced selling, another round of margin-driven liquidation, or open interest collapsing again while price makes new lows. Capitulation is usually a one-time flush, not repeated identical flushes back-to-back. Scenario 2 is the dead cat bounce. In this scenario, the first crash was the first forced unwind, then price bounces because it's oversold, then it rolls over again because the bigger players still have to unwind more, or because macro conditions stay tight, or because liquidity remains poor. This scenario is common in leveraged assets. What invalidates it? A strong reclaim of key levels with stable volatility and improving liquidity, meaning rallies stop getting sold instantly. Scenario 3 is the long repair. In this scenario, the crash was so violent that trust is broken. Even if silver is fundamentally needed, price can chop violently for weeks. The market becomes a battlefield. Buyers step in, sellers hit them, volatility remains high, and it becomes mentally exhausting. This scenario doesn't mean silver is dead. It means it needs time. What invalidates it? A sudden shift in macro liquidity, or a structural physical repricing that forces paper to follow. Now the bigger fear you expressed is, kaya silver ab bilkul crash kar jayega. If by bilkul crash you mean never recover, history suggests that's unlikely. Silver has always been volatile, often brutally, but it has also historically recovered because it is real-world demanded. The more realistic risk is not that silver goes to zero. The realistic risk is that a paper unwind can overshoot further than you think before it stabilizes, and that if you're over-leveraged, you won't survive long enough to see the recovery. Let's talk about why the market feels weird now, because you said it yourself. Ye kaisi market ban gaye hai. This is what happens when markets become financialized. When the paper side becomes larger than the physical side, price becomes more about positioning than reality in the short term. And when positioning is built on leverage, the unwind becomes violent. That doesn't mean physical reality disappears. It means paper can temporarily bully reality. Here's the uncomfortable truth. The most dangerous time to participate in silver is not when it's calm. It's when it's parabolic and everyone is convinced it only goes up. That's when leverage piles in. That's when margin becomes a trap. That's when the unwind becomes inevitable. In every cycle, the trap is the same. The only thing that changes is the headline. Now let's bring history in, because history doesn't predict perfectly, but it does educate your risk brain. One historical pattern is the commodity leverage crash template. A parabolic rise, a violent unwind, a fast bounce, and then either a second leg down or a long consolidation. That pattern repeats across commodity markets because human behavior repeats. Greed compresses time on the way up. Fear compresses time on the way down. Another historical pattern in silver specifically is that the biggest moves often occur around structural pressure points, contract settlements, volatility spikes, policy shifts, or major liquidity regime changes. When silver is treated like a leveraged trade rather than an asset, it tends to punish crowds at the most inconvenient moments. So where does that leave us for the next hours and days? If you're asking whether silver can still fall further from here, the honest answer is yes. A market that can drop 40% in hours can absolutely wick another 10-20% if another forced wave hits, especially if liquidity stays thin. That doesn't mean it will. It means it can. If you need a mental worst-case zone, think in terms of another major leg that tests psychological round levels and forces the last weak hands out. But also understand that after a crash like this, bounces can be savage. The most violent rallies often happen inside the most violent markets. That's why trying to trade your way out emotionally is how most retail gets destroyed. Now let's talk about action steps, because you asked for professional structure and real analysis, not just drama. First, define what you are. Are you a physical holder or a paper trader? If you hold physical silver as long-term insurance, daily price action should not dictate your decisions. Your metal doesn't disappear because the screen is red. The biggest danger for physical holders is emotional liquidation, selling the bottom because the paper price terrorized you. If you are trading paper, you have to respect volatility as a killer. In a market that can swing 40% in hours, leverage is not aggressive. It's suicidal. The best traders in the world don't survive because they're always right. They survive because they manage risk so they can stay in the game. If you're exposed through futures or heavy margin, your first priority is not profit, it's survival. Second, watch the 4-signal checklist instead of headlines. Watch whether open interest is still collapsing. Watch whether liquidity is returning. Tighter spreads, less gapping. Watch whether volatility begins to compress. Watch whether the dollar and real yields stop pressuring metals. If these signals stabilize, your probability of a durable low increases. Third, stop thinking in one decision. In high volatility regimes, good decisions are staged. If you're accumulating, you don't go all in one candle. You scale. You leave room for the market to be irrational longer than you expect. You build a position like a professional, not like a gambler. Fourth, Understand the psychology trap that this market uses on you. The crash makes you feel like the world is ending, so you sell. The bounce makes you feel safe, so you buy back higher. The next dip scares you, so you sell again. That loop is how retail accounts die. The only way out is a plan. If you don't have a plan, the market will write one for you, and it will be painful. Now I'm going to do what most people avoid. I'm going to give you a grounded prediction framework without pretending it's certainty. In the short term, after a 40% crash, a bounce is statistically likely, sometimes sharp, sometimes immediate. But whether that bounce becomes a recovery or a trap depends on whether forced selling has ended. If forced selling is over, you can see a stabilization phase and then a grind higher. If forced selling is not over, the bounce can be sold into, and you can see a second leg down. In the medium term, if physical demand remains strong and industrial demand does not collapse, paper price eventually has to realign with reality. That process can take time and it can be ugly, but it tends to happen because you can only suppress scarcity for so long before delivery stress shows up. In the long term, silver's story is never smooth, but it's hard to make the case that silver becomes worthless. The real risk is not worthlessness. The real risk is volatility, timing, leverage, and psychology. Now I want to talk directly to the global audience because you said you're making this for the world, not for one country. The pain of this crash is universal. It doesn't matter if you're watching in the US, the UK, Canada, Europe, the Middle East, Pakistan, or anywhere else. The paper price is global. The fear is global. But the access to physical metal and the premiums you pay are local. That means two people can experience the same silver price and live in two different realities. One person sees X on the screen and can't buy metal at that level. Another person can buy, but only with huge premiums. Another person is trapped in paper exposure. That is why understanding structure matters more than following headlines. And here's the deepest part of this entire story. In moments like this, markets are not pricing silver. They are pricing trust. Trust in liquidity. Trust in paper claims. Trust in the ability to exit. When trust breaks, price becomes violent. When trust is rebuilt, price becomes stable again. That's why nothing makes sense during an unwind, because what's being priced isn't the thing you think it is. Now let me finish with the identity moment, because this is where you decide whether this market destroys you or educates you. There are three types of people watching this right now. The first type is the wiped out trader. They were over-leveraged, they believed the rally was guaranteed, and the crash didn't hurt them. It removed them from the game. The second type is the frozen holder. They're paralyzed, refreshing charts, hoping the market fixes itself, letting fear decide for them. The third type is the structural observer. They're not numb. They feel the fear too, but they're using the fear as information. They're asking what broke, what changed, what's the system doing? They're building a plan, not chasing emotions. Which one are you? Here's my comment prompt for you, and I want you to answer it honestly. Do you believe this was the final forced unwind, or do you think there's still leverage hidden in the system that can create another leg down? And if you're holding physical silver, are you reacting to the screen or to the reality of supply and demand? Drop your answer below. I read every comment. And if you want, I'll make a follow-up video that does one thing only. I'll break down the post-crash signals in real time. What confirms a bottom, what confirms a trap bounce, and what confirms that the unwind is still alive. Because silver didn't just crash. A system unwound. And once you understand how unwinds work, you stop being the exit liquidity. This is not financial advice, this is education. Do your own research, manage your risk, and most importantly, don't let one violent day force a lifetime decision. If this video helped you understand what actually happened, hit like so more people can see it, share it with someone who is panicking, and subscribe if you want structure instead of noise. The next 48 hours after a crash like this are where most people make their worst decision. Don't be one of them.